into what happened this week. Pretty much the entire week we've been green, which is good. Definitely a nice change from last week. And
Yeah,
you can't see it on your chart, but after hours we had a pretty big move. We're recording this on Thursday, and had a pretty big move after hours from earnings. So we'll see if that kicks off a move above mid vamp and potentially towards upper vamp. That would be nice. We'll see where that goes. But something that's come up this week, especially with the GDP print, is people are calling for stagflation. So they're saying inflation is high and now growth is slowing. So we are entering a stagflationary period. Our system is not printing stagflation. So we don't agree with that. But what do you think of that bear case? I guess that would be a bear case because we did see stagflation throughout all of 2022, and that was very bearish for equities, very bearish for bonds. Is that something that could possibly happen again?
yeah. Of course, stagflation can happen at some point. It's not impossible, right? Given the current environment, if you follow our compound lending theory, which is um, the economic cycle the cycle that's specific to this economic environment where we have a very hyperactive Federal Reserve that hiked aggressively in a short period of time, and they're likely going to overstay their welcome in restrictive territory before finally really reducing interest rates materially only after the slowdown slash recession emerges, not so much in line with it, which is how we define the stages. Stage one and two already happened. We're in stage three, where the economy attempts to normalize right after the Fed raises rates, called the normalization stage. And then the following stage is the hard landing stage. And that is obviously an event driven by the Fed at that point. The Fed staying too restrictive for too long. And I mean, we can look at just short-term real rates. If we look at this as the one-year benchmark U.S. real yield, which is taking the one-year Treasury yield minus the one-year inflation swap yield, and we're at 250 basis points right now. This is pretty much the highest since '08. This is in well restrictive territory. So the market on a rate perspective is very restrictive. The yield curve still inverted, right? So we're still in an inverted yield curve environment. Again, a sign of restrictiveness. And I want to go back to your point that you said earlier. The NASDAQ is up in the after hours. We're recording this. The after hour session is closed, but the NASDAQ is up. You can even see the futures here up 1% right now. And they're up on the the Microsoft and the Google earnings releases. They were down yesterday. We opened down this morning on the Meta earnings release. Now, what you'll notice is we also opened down on that GDP print you were talking about, but the market prior to Google and Microsoft releasing earnings rebounded throughout the day. Now, GDP came in at 1.6% quarter over quarter. The first reading is 1.6%. And this is from the prior reading of 3.4%. So quite a decline there. Now, like you said, that's stagflationary, especially if you couple that with the reading that we got on the prices paid and the GDP breakdown that showed prices paid accelerating. So people are automatically looking at, growth slowing, inflation accelerating. That's stagflation. And it's not so simple. Now, I want to take a look at GDP in a second. We'll break it down. But to go on with equities here, Qs are up after hours. We're going to probably be around mid-vamp at the open tomorrow unless something significant happens, which we do have PCE in the morning, so that's going to be a determining factor. And for those that are listening to this over the weekend, you guys will know how the market played out into PCE, but I can't tell you how it's going to play out. I suspect there to be some good price action the next couple of days after into next week, given that we've just come down quite aggressively. And the reasons for coming down, we will talk about in a second. But as long as we can hold up and break above and really break through mid-vamp here on the NASDAQ and the S&P 500, I think the market can go higher. But until we really clear those levels, if there is a bad PCE print or a bad reaction to a PCE print for whatever it may be, and we can't clear that mid-vamp level on Qs and SPY, then expect further bullish trend consolidation, which is what we've been seeing here, where we kind of are coiling and basing And as long as we're not above mid vamp, lower vamp, Momo, and this sideways consolidation is the most likely outcome. But let's go over GDP. So if we take a look at GDP and we measure what exactly is going on here and how we break it down, you can see that GDP came in at 1.6%, down from the prior print. And obviously there's a slowdown there. But if we take a look at the actual components of GDP and we eliminate a lot of the noise such as imports and government spending, etc., and we just isolate the demand component of GDP, and that's going to be the net consumption plus investments, which is also known as final sales to the private domestic purchasers, and we look at that on a quarter over quarter basis. What you're going to see here is this is still well positive. This hasn't really declined much. And this is showing you that the demand within the GDP growth number is strong. Now, you might say, okay, why even look at this? Well, if you go back to 2022 and we zoom in here, you'll see that in 2022 we had those 2 quarters of negative GDP prints that were technically a recession, but the economy didn't obviously go into a recession, but the stock market did sell off into this whole down print, right? Into these 2 negative prints. What you'll notice is that net demand did not go negative and went negative a couple of quarters later, barely, and it was just 1 print and then flipped back to positive. So interestingly enough, we didn't have a recession. It was one of those things, well, why didn't we have a recession? And the answer is you didn't get enough of a breakdown in this final sales to private domestic purchasers number, excuse
Well,
me.
at the end of the day, though, we did get a sell off in equities.
Correct, but in terms of a classifiable recession, so you get the breakdown in equities, right? And if we go back to the Nasdaq here, we get this huge sell-off, right? Basically a manufacturing / earnings recession, right? But you don't get this economic recession. You don't have this actual classifiable recession where unemployment's accelerating, right? You don't have this recession where growth is really in the gutter. I mean, we're talking about two negative GDP prints that one was actually negative and the other one was already on the way back to positive, and then we finally just climbed out of it after 2 prints. And something interesting to note here, going back to 1950, right? If you look at the final sales to private domestic purchasers breakdown in GDP, which is essentially you're measuring the demand and the strength of the GDP number, there has never been a recession without this number being negative. So for us to get a recession, going back to the 1950s, based on all the recessions that have occurred between now and then, at some point, this sales to private domestic purchasers number is going to have to be, this demand number is going to have to be negative. So what happened
We
is,
still have quite a ways to go till then.
right. So what you saw was this GDP print come down, right? But you saw the net demand behind GDP actually not change much. So, and one of the things that was weighing on this GDP number was a negative contribution of net exports, right? Which isn't that much of a heavy factor in terms of the actual functioning prospect of demand within the economic growth cycle, right? So, like the fact that by eliminating these things you have this positive number. I'm not saying, look, we're going to start eliminating things and you can't look at certain things, because we all know at the end most of that is nonsense. That's how people come up with core, super core. That's really for the super simps, right? We're simplifying this to a certain aspect of the growth number, the real growth number. We want to isolate demand and we just take a look at it. And there's obviously not so much of a slowdown in those numbers compared to where the actual quarter over quarter print came down. Now, will we see revisions to the print? Yes, it's possible. But you just need to know that we haven't seen, there hasn't been a recession without this number being negative. Literally. I mean, just in you could see right here in the last 2 recessions, right? This number is negative. Go in or around that recession, or around these recessions.
And I mean, outside of that COVID recession, like it kind of starts falling before the recession hits. And
correct.
I mean, at 1.6%, it's still pretty high up there.
It's actually above.
It's very much in line with historical performance.
Right. So now you want to take a step back, though, right? We don't want to isolate and harp too much on independent, or I don't want to say independent, but specific variables, right? We don't want to put too much weight on these specific variables and like this more breakdown or niche type of analysis. It's important because if you just look at GDP as a whole, you're like, oh my god, it's slowing, and the prices paid are going up, and the market's selling off on it. But then you realize once the market opens, money came in and bid it the whole session up. So you look at it and you're like, okay, it's not that, it must not be that bad, at least not yet. Again, look at the demand component here. In 2022, this was fading into 2022, right? We saw this fading into 2022, and with that, equities did too into 2022 on the fear that this would go negative along obviously with the overall GDP number already in negative territory. That did not happen. So you had this earnings recession, markets priced in basically a recession. And we were very vocal about this in 2022. We were literally saying that unless growth and inflation unless growth beats to the downside and inflation beats to the upside, the recession is not going to happen because the market's already priced it in and it's very clear it didn't happen. And unless you can beat those expectations in both directions, the lows were likely in. I mean, we have multiple podcasts in 2022 literally claiming the lows are likely in, and they have been so far, and they likely are at this point in the cycle, unless any type of drastic change happens here with growth. But until that we see that, this is just another confirming indicator. Look, the economy is not as weak as everyone expects it to be. Now people look at the Fed and say, oh, that means the Fed doesn't have to cut interest rates. And that is a mistake, I think. That's where you start making the mistake of saying, look, the Fed is in fact restrictive. We know that they're quite restrictive. I mean, the yield curve's inverted, real rates are quite positive. And people look at things like real GDP and say, "Oh, we're weakening," but even the demand part of GDP is strong, so the Fed can still keep rates higher, and or some people claiming hiking because of the stronger inflation metrics in the GDP report. But you have to take a step back and say, "Look, there's some cyclicalness to this data, right? Like just because it's strong today doesn't mean that if the Fed keeps rates higher for longer from here, it's going to continue to be strong going forward because there's a lag in the policy. There's a lag inherently in what the Fed does, and that lag is pretty much unmeasurable across all institutions. No one can really put a finger on what that time frame is. Some say it's 12 months, some say it's 18 months, some say it's 6 months. No one really knows. But ultimately, there's a lag to Fed policy because there's ripple waves that happen between when the Fed raises interest rates and when it reaches the end consumer.
And the
And
Fed is well aware of that. Like
oh yeah, they literally vocalize. They're vocal about it.
I highly doubt they're gonna raise rates.
No,
There's
they're
no
they're
way they're
not.
that stupid.
No.
I really hope that they do cut because we are very much nearing the tail end, and I feel like growth is very much starting to slow. It's not where it used to be.
Yeah, yeah, and I think that if the Fed has this. Some want to claim it no landing, whatever you want to claim. Look, the Fed has the ability to bring rates down gradually, if it's every other meeting, whatever it may be. The Fed has the ability to bring rates lower gradually without coming off as hyper cutting, all right? And in the process, monitoring growth. Now, if growth starts to firm up and start accelerating, the Fed can say, okay, look, we can pause, and inflation accelerating along with it. We can pause after one rate cut, investigate, see what's going on. But to sit here and just basically wait to start the cutting cycle methodically, saying like, okay, we're going to start cutting. When we do, we want to cut meeting by meeting by meeting. I think what they're essentially doing is they're waiting for the first sign of weakness, and then they're going to do a meeting by meeting cut. But that cycle, that entire cutting cycle, is so stretched, right? You're talking about 200 basis points every year at one cut every meeting. So you're talking about to bring rates down 200 basis points is going to take 12 months, whereas you can get the process started earlier and you put yourself in a better position. Also, everyone's also looking at inflation, wondering, oh my God, inflation's accelerating, when in reality, we know that inflation's just bouncing around. And let's even look at commodities, right? Look at crude. So if we take a look at crude oil here, we are in between 2021 levels and 2022 levels. We are well below the 2023 highs. We are well above the 2023 lows, but we're pretty much in a price range here that's been going sideways for quite some time, albeit, the 2023 peak and then the crash down in late 2023, that wild range there from lows to highs to lows. We're still within the 2023 range, and we're pretty much going sideways right now. Does this go higher? Can it go higher? Yes. I think we should start getting concerned near 2023 highs that inflation likely is more problematic than it should be. But until you're really breaking out above 2023 highs on energy and commodities as a whole, right? You can't sit there and say, look, inflation's heating up, it's running away from us. Like your annualized number that your year over year number that you're focusing on might be bouncing around, right? Let's take a look at inflation, right? That year over year number might be bouncing around, which we know. Again, also bouncing around in between the 2011 peak and 2018 peak. So we're not even near the 2008 peak.
Yeah, and it's definitely not out of control.
No,
If we get
definitely not.
above the 2011 peak, then we can start making the argument that it is beginning to get out of control. But
Right.
we need to see that first, and that's just not happening. And I think we should segue into Bitcoin, the way that has been moving. Really not selling off, definitely not indicative of a risk off regime or a stagflationary regime. And it's very much so supporting our theory that this sell off in equities is not going to last and that we are headed towards the highs again.
Yeah, so I think I brought this up a couple of was it a week ago now? About a week ago from today's date on X. And I literally tweet scamwick question mark here. And I see this price action happening. I'm like, okay, like we took out we tried to make these lows here around 60K. We flushed through it and we bounced back, and then we hold above it, and the next day we reverse. And through this day, I'm like, is this a scam wick? I'm not sure, right? I'm just questioning. And so far, it looks to be like it just looks to be one of those types of liquidations that blows through a level and comes back up. And this is just a round number, around 60,000, right? And this shows that, look, we flushed on this whole. I think we should elaborate a bit more on what happened here and what I think happened in the markets with this whole GDP print, and then go back into Bitcoin, because it's going to reveal what I think kind of led this all off. I think this all started with the Israel and Iran nonsense, right? That type of back and forth headline volleyball. We started selling. Then we started hitting sell marks for systematic funds, and they pushed it even further. And I think that the general consensus was that the high of 3.4% GDP print, the real GDP number that we saw, was likely the peak for a while. And now you're going to have headwinds going forward, just lower prints, right? The peak growth is in. So now the argument's going to be, well, if peak growth's in, how much are we going to slow? And Atlanta Fed was showing us that GDP was estimated to be at like 2.7. It came out at 1.6. So Atlanta Fed was at 2.7, which is already slower than the prior quarter. But we came in at 1.6. And I think the market was somewhat estimating that there might be some sort of slowdown there, greater than what even the models were forecasting. And I think that helped bring the market lower, because in my opinion, if the market was really seeing that type of slowdown from 3.4 to 1.6 and was really shocked, even if it was, real demand was still positive, I think we would have seen a bigger dump on the initial print. I mean, if we go back to what happened in the morning, I mean, we only dumped, so what is it, like on the print, we only dumped from 81 basis points. Like, understand that is nothing in compared to what we're used to in this environment.
With a miss that big.
Yeah. I think the market had at least some understanding to a degree of what was going on. Either that, or in fact, it was so smacked on all this other noise that there really wasn't much else that was going to be able to destroy it from there. We'll have to see how this trades in the following days. If we can get back above mid-vamp, like I said earlier, we can go higher. But let's go back to Bitcoin. I know we just hopped off of it. Want to come back, and we had that same type of price action happen with Bitcoin, except you didn't have the systematic selling. And that's very clear here. We had the headlines come in, but there was no systematic selling thereafter. We had that altcoin leverage liquidation run. We saw that happen pretty much 2 weeks ago, right? But we didn't have the same type of follow through that we saw in equities. And that, I think, in itself was a sign, because like you said earlier, when we get into a risk-off environment, Bitcoin is sold. Nobody holds it. It's bearish trend pretty quickly, and it just goes down sideways to lower. That's what tends to happen. Now we're not seeing that right now. We're actually seeing it put in higher and supportive lows. And I think that yes, we have some lower lows, lower highs being formed here. You can claim all your little heads and shoulders, whatever chart nonsense you want to do, waves and this and that. At the end of the day, all you need to know is this: as long as Bitcoin is above Momo, this is bullish trend consolidation. As long as Bitcoin is above mid vamp, the odds exponentially increase for new highs, new cycle highs, up mid vamp and then higher. So until we're above mid vamp, this bullish trend consolidation can easily continue. Pretty much like what's going on in the queues right now. Until we clean up that price action and break up higher, it's once you get that things start to accelerate. That's when we start to see things like this, right? Look back in 2024 after the ETF approval, we were consolidating, get above, hold, consolidate above, and then it's a pump. And that's pretty much what Bitcoin does and historically has done. It does the best and performs the best and creates the most euphoria when we're above mid vamp. So don't expect any type of hype to really come out of anywhere until we're back above mid vamp and we're trending higher. And we think that's still a great possibility, a high possibility in the current regime that we're in.
Yeah, and
But the
bottom line, in terms of regimes, nothing has changed. Nothing has changed at
literally
all. Growth
nothing.
growth remains strong. Inflation remains under control, and obviously it's not at the 2% target, but it's going to take time to get there. Rates are not moving higher anytime soon, and nothing has changed.
Yeah,
Literally
it's
nothing
fun.
has
It's funny.
changed.
It's funny you say that because this resiliency and the demand part of the GDP number, like our system has been sniffing this out, right? Like just even though GDP declined from 3.4 to 1.6, like the system has been quite resilient for a reason. And I think that a lot of people are looking at not at headline prints and getting scared, and they're not realizing that look, like at the end of the day, unless GDP is going to significantly get lower from here, I mean, we're talking about going towards zero, and this is not a one off print, then you're going to be very surprised on how the markets react going forward. And I think what you need to understand with that is you need to look at the bigger picture, zoom out, take a step back. Don't harp on a single data point. Don't focus on, oh, the 10-year is this value. The 10-year is this value or whatever it is today because of X, Y, and Z. And within 30 days, a 10-year can be a different value, right? The 10-year is not the defining factor of the stock market. You need to zoom out. Gold, the price of Bitcoin, the price of gold is not the defining factor. Put everything together. Look at everything as a whole, right? And when you and to do that, you need to have a systematic approach. Everything we do is 100% systematic. We do not sit here and have feelings. Do I think that we're going to make new equity highs and new Bitcoin highs? Yes, I do believe that right now. Can I be wrong? I could be. The system will signal that I am wrong before I'm in I'm in deep shit. So that's the point here. The system will guide me, tell me what to do, or at least give me the indication on what I should do. And you take action upon those signals. Not sit here and say, we're not going to be the people that with the NASDAQ at 380 that says, yeah, the highs are still coming. That's not going to be how this works. At that point, something significantly would have already shifted, and our system would have already significantly shifted, right? We would already be in a different stance well before we get there. So you have to always look at the big picture, zoom out. At this point, we still believe new equity highs, new Bitcoin highs are coming. The cycle is still intact, but until something changes, we will stay the course. And if you like what we're talking about, or you want to learn more about what we're talking about, we have a daily quant deck, which is our daily report that's updated daily with information that includes the system, trends, our liquidity index, and just an overview on each important economic environment across the globe. If it's the United States, Eurozone, Japan, these are all summarized in the quant deck on a daily basis. You can find out more about that on our X page at the Market Radar or on our website at market-radar.com.